Let's get into equities with coming to the end of US reporting season. What have been some of the reflections in light of what we're seeing in markets? Grant Mundell joining us from Equity Trustees. Grant, good to have you back on the show. Welcome back. So, of course, we've just heard from the Fed. Would you say that, in particular, the US markets are overly optimistic, given there's still no deal done in terms of the tariffs?
Yeah, no deal done at this particular point in time. It's going to take a little bit of time, I would suspect, for the US and China to flesh out all the aspects. So it will take a little bit of time. So that keeps us a little bit cautious given the rally that we've seen in markets in the near term.
All right. What are your observations, though, given what we've heard from US reporting season? And clearly, companies are reluctant to give guidance given the current environment.
Yeah, look, overall, actually, US reporting season's been quite reasonable. I mean, about 80% of the companies have reported in line or beaten earnings expectations. Earnings growth has been pretty strong at 14% year on year, and companies have positively surprised by around 10%, and really it's been margins that have been better than expected. But as you can imagine, and as you stated just there, forward guidance has proven very difficult in the current environment. And that has led to negative earnings revisions in consensus numbers of around 2 to 3%, but also notably a pullback in CapEx intentions until we see a bit more certainty. A couple of interesting sort of themes that we have seen through that US reporting season. Firstly, obviously, tariffs are the most talked about factor, and many companies obviously talking about how much it will or won't impact them and how companies are really trying to pivot to deal with them, such as altering supply chains and alike. The consumer-facing sectors were probably the hardest hit by those negative earnings revisions, with several companies pointing obviously towards the fall in consumer sentiment. It's interesting, you noted that Jerome Powell did talk about the US economy holding up, and the hard data has actually been okay, but it's really about those forward-looking indicators which are softening, and the key will be to see if that hard data rolls over or not. And lastly, I think the other theme notably was around artificial intelligence, because we have seen the tech sector in the US really sell off in the course of that March quarter and in April to some degree. But demand for AI remains very robust, and certainly there's still a fair bit of enthusiasm around AI. Several companies still talking about the tangible benefits from AI coming through in terms of cost reductions and productivity benefits. And despite the impact of DeepSeek in that first quarter, you've had megatech companies such as Meta reiterate their confidence in the longer-term growth opportunities by increasing their CapEx in the space.
Yeah, also some developments overnight to report that Apple looking to add AI search options to its web browser. So interesting to see whether it pursues that. Also, the Trump administration confirming it's planning to loosen those restrictions on exports of advanced AI chips.
Yeah, that's right. So we did see, I think, Nvidia stocks like Nvidia have a bit of a rally on the back of that. So there was some of the I guess the chip constraints. So trying to loosen a few things up, but really I think it's going to be about the development of this de-escalation of the trade talks between China and the US in Switzerland, and how that develops and how quickly things can develop, which is going to give, I think, the market the next leg of growth or next leg of confidence effectively.
Meanwhile, Grant, what are you noticing here at home then? You talk about where the US economy is at. Relatively, how do you assess the Australian economy at this point?
Yeah, well, the ASX has rebounded very strongly after those initial equity market falls in April, and it's actually been one of the standout equity markets over April. And I think that has been in part due to the fact that not only is Australia less directly impacted by the US tariffs, but many Australian corporates are pointing to a range of positive factors associated with Australia. And they're highlighting things such as the strong governance and the institutions we have, the resilient economy, near-term monetary and fiscal policy support, and political stability. And that's actually seen strong international flows into the Aussie equity market. Also, if you look at some of those recent company announcements, they've pointed to a reasonably solid consumer overall here locally, and a more supportive backdrop for the housing market. So it's fair to say that I think Australia is relatively well placed. However, we are still susceptible to potentially some of those indirect impacts, which obviously, China's the key one we're watching on the back of the tariffs.
You mentioned that political stability. Of course, we've just had the election. Any implications then in terms of the government and its very solid mandate?
Yeah, look, on average, equity markets typically rise post an election as that uncertainty lifts. So, as you know, equity markets like certainty and stability, and we'd say that the government's economic policies are unlikely to shift majorly. So, the market knows what it's going to get, and that's a good thing. We think that overall government spending should remain supportive, which has been a major factor in our economic resilience over the last couple of years. The housing market should be supported while obviously trying to also increase supply. And support to the consumer should be somewhat forthcoming through those cost of living relief and tax cuts. And that should complement potential rate cuts from the RBA. Lastly, a majority government should enable policy decisions to be progressed, and hopefully that could open the opportunity for policies to boost productivity, which is another way to boost real income. So overall, we'd see it as a small positive, but again, the global trade tariffs remain the most important factor in the near term.
So, Grant, given all of what you've just said then, how are you positioning yourself in terms of asset allocation locally?
Yeah, look, despite Australian equities being relatively well insulated versus other countries, our equity market here isn't cheap, unfortunately, and there's still the risk of earnings downgrades, which are only trickling through at this particular stage. So we think earnings downgrades could come through in the order of around 5%. So you just have sort of flat year-on-year earnings growth for FY26 on FY25. And despite the de-escalation, talk last night, we still see the US installing some sort of tariff reform. That negotiation between the US and China, as I mentioned, could take some time. And the US market, as we sort of, we're hinted to by Jerome Powell last night, has some stagflationary concerns there. So given the Fed's on a bit of a wait and see mode, they may only move once growth is actually really at risk. So given that, we've still got a small tactical underweight to Australian equities and international equities, and prefer the A-REITs and the defensive asset classes.